Most investors are looking at their screens, seeing tons of companies that look expensive. They see a price tag that suggests that growth is already priced in. But what if I told you the numbers you're seeing in your brokerage app are kind of misleading? Welcome back. Today, we're taking a look at a business that almost everyone owns, but almost no one is valuation tracking correctly, and that's Visa. While the headlines are focused on litigation and merchant settlements, the economic reality of this business is telling a completely different story. We are currently looking at a rare opportunity where the gap between the headline price and the actual earning power is the widest it's been in years. Let's look past the noise and see why this is the ultimate toll booth play for 2026. To understand why Visa is a cornerstone of a compounding portfolio, you have to understand what they don't do. Visa is not a bank. They don't lend money, and they assume zero credit risk. They simply provide the rails that digital commerce runs on. Think of it as a global tax on spending. Whether you're buying coffee in London or a laptop in Tokyo, Visa takes a tiny slice of that transaction. They operate in a rational duopoly with MasterCard, creating a network effect that is nearly impossible to displace. To beat Visa, you'd have to convince billions of people and millions of merchants to switch their behavior overnight. That isn't just a moat, it's a fortress. And because they take a percentage of the transaction, they are the ultimate inflation hedge. As prices go up, Visa's revenue grows automatically without them ever having to raise prices on their customers. It's the definition of a clean, high-margin, compounding machine. So if the business is this good, why is it trading at a discount? This is where the accounting noise comes in. If you look at the standard PE ratio today, it looks high, well into the 30s. But that number is being distorted by a massive one-time legal settlement regarding merchant swipe fees. This is paper noise that doesn't reflect the actual cash flowing into the business. When you strip away these non-recurring charges to find the sustainable earnings, the valuation drops significantly. In fact, on an adjusted basis, Visa is trading at a level that is rarely touched in the last 5 years. We're talking about the 15th percentile of its historical valuation. You are effectively buying one of the world's most profitable companies at a price the market usually only reserves for the average businesses. This is the definition of quality at a reasonable price. Technically, the stock is currently trading right at its 200-day moving average. In a healthy market, that's usually just trading sideways. But for a high-quality compounder like Visa, it signals opportunity. It means the market is temporarily distressed over regulatory headlines that are transitory in nature. Now, what's the real risk? The bear case here is almost entirely political. New mandates like the Credit Card Competition Act could force Visa to lower its toll. While this wouldn't destroy the business, it could compress those high margins. However, even in that scenario, the sheer volume of global digital commerce is a tailwind that is very hard to stop. By buying while the stock is under this regulatory cloud, we are getting a margin of safety that simply isn't there when the news is all positive. For my portfolio, I'm dollar cost averaging into Visa and staying active until the valuation catches back up to its historical norms or the price moves significantly above the long-term moving average. We're looking for that compounding engine to keep humming at double-digit growth. This is the goal. Find the best businesses in the world and wait for the market to get confused by noise, and then accumulate. What's your take on the regulatory pressure on Visa? Is it a structural threat or just another hurdle? Let's talk about it in the comments. If you want to see the specific data behind the analysis, make sure you're subscribed for our weekly updates. I'll see you in the next one.